Welcome. Today, we're going to address a question that most people think about but rarely discuss honestly. What does it actually take to reach the top tiers of wealth in this country? Not the fantasy version, not the social media highlight reel, the real numbers. This isn't about making you feel inadequate. It's about clarity. Because without an accurate map, you're navigating blind. And in finance, blind navigation destroys more wealth than almost any other mistake. The top 1%, the top 5%, the top 20%. These aren't just numbers. They're thresholds that separate fundamentally different financial realities, different levels of security, different degrees of freedom, different relationships with risk and time. Here's what surprises most people. The gap between these tiers isn't linear. It's exponential. The difference between the 20th percentile and the 5th percentile is significant. But the difference between the 5th percentile and the top 1%, that's a different universe entirely. Why does this matter right now? Because we're living through a period of historic wealth concentration. The distances between these tiers are widening, not shrinking. Asset inflation has moved faster than wage growth for over a decade. And most people are operating with outdated assumptions about what these thresholds actually represent. This conversation isn't about envy or resentment. It's about strategic awareness. You cannot build an effective financial plan without understanding the terrain. You cannot make rational decisions about risk, savings, and investment without knowing where you actually stand and what the next level actually requires. Over the next 25 minutes, we're going to examine the specific wealth thresholds for each tier. We'll explore how people actually accumulate wealth at these levels. We'll discuss the psychological and strategic differences between these groups. And we'll address the brutal realities that most financial content conveniently ignores. This will be direct. This will be honest. And if you're serious about building lasting wealth, this information is essential. Let's begin. First, let's establish our baseline with current data. To crack the top 20% of household wealth in the United States, you need a net worth of approximately $600,000. This includes everything: your home equity, your retirement accounts, your investment portfolios, everything minus all debts, $600,000. For context, the median American household net worth sits around $200,000, so you're looking at roughly 3 times the median to reach this threshold. Now let's move up. The top 5% requires approximately $2.6 million in net worth. Notice the jump. We've gone from 3 times median to 13 times median. This isn't a gentle slope, it's a cliff. And the top 1%? The threshold currently sits around $13 million in net worth. 13 million. That's 65 times the median household wealth. That's 5 times what you need for the top 5%. These numbers shift slightly depending on which data set you examine and the specific year, but the proportions remain consistent. The gaps are enormous and growing. Let's be clear about what net worth means in this context. It's not income. A surgeon earning $600,000 per year might not be in the top 5% of wealth if they're early career, carrying significant debt, or spending at a high rate. Meanwhile, a retired couple with a paid-off home and a modest but well-managed portfolio might sit comfortably in the top 20% despite modest income. Wealth is what you keep and grow. Income is what flows through your hands. The confusion between these two concepts destroys more financial plans than almost any market crash. Here's another critical point. These thresholds represent snapshots, not destinations. The top 20% isn't a plateau where you arrive and relax. It's a dynamic position in a moving system. Inflation, asset appreciation, and the wealth accumulation of others means this target is constantly shifting upward. 20 years ago, reaching the top 20% required significantly less in absolute dollars. 20 years from now, it will require significantly more. This isn't pessimism, it's arithmetic, and it has profound implications for how you need to think about wealth building. The question isn't just, can I reach this number? The question is, can I reach this number fast enough, and can I stay there once I arrive? Most people dramatically underestimate both the target and the trajectory required to hit it. They assume linear progress in a system that rewards exponential positioning. They plan for yesterday's thresholds while living in tomorrow's economy. This is where most financial plans fracture before they even begin. Now let's discuss how wealth actually accumulates at these different levels, because the path to the top 20% looks fundamentally different from the path to the top 1%. For the top 20%, the wealth composition typically looks like this. Primary residence equity represents a substantial portion, often 40 to 50% of total net worth. Retirement accounts, the 401ks and IRAs, form another large segment. Some taxable investment accounts, perhaps a small business interest or rental property. This is achievable through sustained high income, disciplined savings, and time. A household earning between $150,000 and $300,000 annually, living below their means, consistently investing over 20 to 30 years, can absolutely reach this threshold. It requires discipline, but it doesn't require extraordinary circumstances. The path is clear. maximize tax-advantaged savings, build equity in appreciating real estate, maintain consistent market exposure, avoid catastrophic financial mistakes. Time becomes your most powerful ally. But watch what happens as we move up. The top 5% begins to show a different pattern. Primary residence equity becomes a smaller percentage of total wealth, not because the homes are worth less, but because other assets have grown larger. Business ownership or equity compensation becomes more prominent. Investment portfolios outside retirement accounts become substantial. Multiple properties appear more frequently. This level typically requires one of several catalysts, either sustained very high income, usually exceeding $400,000 annually, or significant equity events like selling a business, receiving substantial stock compensation or inheritance, or early entry into assets that experience dramatic appreciation like certain real estate markets or early stage investments. Time alone isn't usually sufficient here. You need either exceptional income or exceptional returns on capital, or both. Then we reach the top 1%, and the composition shifts again. Business ownership becomes dominant. Corporate equity, private company interests, substantial investment portfolios generating their own returns, real estate investment beyond primary residences. At this level, we're almost always discussing one of three paths: building and selling businesses, long-term equity compensation at senior corporate levels, or generational wealth transfer and professional management. The working professional who simply saves their way into the top 1% is vanishingly rare. Not impossible, but rare enough to be statistically insignificant. The mathematics of high-income saving versus the threshold simply don't align for most careers. Why does this matter? Because your strategy must match your target. If you're aiming for the top 20%, the conventional advice actually works. Save aggressively, invest consistently, manage costs, benefit from compound growth. This is proven and achievable. But if you're targeting the top 5 or 1%, conventional advice becomes insufficient. You need asymmetric opportunities. You need to build equity, not just accumulate savings. You need to take calculated risks with portions of your capital. You need different strategies entirely. Most financial content lumps all of this together under generic advice about building wealth. But there isn't one path. There are multiple paths, and they diverge sharply at different levels. Understanding which path you're actually on versus which path you think you're on might be the most important financial clarity you can achieve. Let's talk about time, because this is where mathematical reality collides with human psychology. Assume a household earning $150,000 annually. They save 20%, or $30,000 per year. They invest it consistently, achieving a 7% average annual return after inflation. How long does it take them to reach the top 20% threshold of $600,000? Approximately 14 years. 14 years of sustained discipline, no major setbacks, consistent market returns. It's a long time, but it's achievable within a working career. Now let's run the same scenario targeting $2.6 million for the top 5%. Same household, same savings rate, same returns. How long? Approximately 28 years, almost 3 decades. And this assumes no disruptions, no market crashes that derail sequence of returns, no life events that interrupt the savings pattern. For the top 1% at 13 million, we're discussing time horizons that exceed typical working careers. Even with perfect execution, even with favorable market conditions, the mathematics become extremely challenging for earned income alone. This is the brutal truth that most financial advice glosses over. Time works magnificently for reasonable goals, but time alone cannot overcome the exponential gaps at higher wealth tiers without either dramatically increased income or dramatically increased returns. And here's where it gets psychologically difficult. The wealth accumulation curve is not steady, it's backloaded. The first 100,000 takes longer than the next 100,000. The first decade of wealth building is primarily about behavior and discipline. The second decade is where compound returns begin accelerating meaningfully. The third decade is where previous decades of compound growth create momentum. But most people don't experience it this way emotionally. The first decade feels discouraging. Progress seems slow. The gap between current position and goal appears insurmountable. This is where most people either abandon the strategy entirely or make desperate, high-risk decisions seeking shortcuts. The middle years bring different challenges: lifestyle inflation, family expenses, the temptation to consume today rather than invest for tomorrow, the psychological strain of sustained delayed gratification while peers appear to live more comfortably. The later years, if you've maintained discipline, finally deliver the exponential rewards. But many people never reach this phase because they couldn't maintain strategy through the earlier, slower phases. Here's what the data shows clearly. The difference between households that reach these upper wealth tiers and those that don't isn't primarily about earning power. It's about behavioral consistency over time horizons measured in decades. Most people have a 10 to 15 year investment horizon, even if they claim longer. They'll stick with a strategy for 10 to 15 years. If they haven't seen sufficient progress by then, they abandon it. They They restart with different approaches. They chase different opportunities. But 10 to 15 years is exactly where the compound curve begins accelerating dramatically. Abandoning strategy at this point is like hiking 90% of the way up a mountain and turning back. The psychological challenge isn't the strategy. It's maintaining the strategy long enough for mathematics to work. Most people dramatically underestimate how long this takes, and they dramatically underestimate their own ability to maintain discipline over these time horizons. This might be the single most important insight about wealth building. It's not complicated, but it is hard. And hard doesn't mean complex. It means emotionally and psychologically demanding over sustained periods. The people who reach these upper tiers share one common trait above all others. They maintained their strategy through multiple market cycles, multiple life disruptions, and multiple psychological challenges without abandoning their approach. They didn't need perfect strategy. They needed sufficient strategy, executed consistently over sufficient time. Everything else is optimization at the margins. Now let's address the psychological patterns that separate successful wealth builders from those who perpetually struggle. First, understand that your brain is actively working against wealth accumulation. This isn't metaphorical. Your neurological wiring, evolved over hundreds of thousands of years, optimizes for immediate survival, not long-term capital formation. The parts of your brain that generate emotion and immediate reward response are ancient and powerful. The parts capable of abstract future planning and delayed gratification, much newer, much weaker, easily overridden during stress. This creates predictable behavioral patterns that destroy wealth. Present bias, the tendency to overvalue immediate consumption versus future wealth. The new car today feels more real than financial security in 20 years. The vacation this month generates more neurological reward than portfolio growth next decade. This isn't weakness, it's biology. But biology that costs people millions in foregone wealth over their lifetimes. Loss aversion. The psychological pain of losing money is roughly twice as intense as the pleasure of gaining equivalent amounts. This creates deeply irrational behavior. People hold losing investments too long, hoping to avoid realizing the loss. They sell winning investments too early, wanting to lock in gains before they disappear. This asymmetry in emotional response leads to portfolios perpetually filled with losers and drained of winners. Over time, this behavioral pattern alone can reduce returns by several percentage points annually. Compounded over decades, this represents hundreds of thousands to millions in lost wealth. Social comparison. Your spending decisions are heavily influenced by your peer group, not your income, not your actual financial position, your perception of peer spending patterns. This is why high-income professionals often struggle to build wealth despite substantial earnings. They're surrounded by other high-income individuals, many of whom spend aggressively. The psychological pressure to match this consumption is intense, even when it's financially destructive. You see the lifestyle. You don't see the debt, the financial stress, the lack of actual wealth accumulation. And so you make spending decisions based on incomplete information, guided by social pressure rather than financial logic. Recency bias. The tendency to assume recent patterns will continue indefinitely. After a strong market period, people assume markets will remain strong. They increase risk exposure at exactly the wrong time. After a market decline, they assume continued decline. They reduce exposure at exactly the wrong time. This behavioral pattern guarantees buying high and selling low. It's the opposite of effective investment strategy, yet it's the dominant pattern among retail investors. Overconfidence. Most people rate themselves as above-average investors. This is mathematically impossible, but it's psychologically universal. This overconfidence leads to excessive trading, insufficient diversification, and assumption of inappropriate risk levels. Every study on this subject reaches the same conclusion. Trading frequency is inversely correlated with returns. The more frequently people trade, the worse they perform. Yet overconfidence drives constant portfolio adjustments, each one generating costs and usually degrading performance. Here's what successful wealth builders understand. You are not exempt from these psychological patterns. Being aware of them doesn't neutralize them. Intelligence doesn't protect you. Education doesn't protect you. Awareness helps, but it's insufficient. The solution isn't trying to overcome these patterns through willpower. The solution is building systems that remove the requirement for willpower. Automatic investment contributions. Asset allocation maintained through rebalancing protocols, spending governed by predetermined percentages of income, written investment policies established during calm periods, followed during volatile periods. These aren't optional optimizations. They're essential protections against your own psychology. The most dangerous opponent in wealth building isn't the market. It's the person staring back at you in the mirror. If you're already accumulating assets, working toward these wealth thresholds, here's what you need to understand right now. Your current challenge isn't finding better investments. It's protecting what you've built while maintaining growth trajectory. This requires a completely different mindset than the accumulation phase. First, understand sequence of returns risk, This is the danger that poor market returns occur exactly when your portfolio is largest. Early in wealth building, market volatility doesn't matter much. You're adding capital consistently. Down markets let you buy at lower prices. But as your portfolio grows, particularly in the years approaching retirement or financial independence, sequence becomes critical. A sustained market decline when you're at 600,000 hurts far more than when you were at 60,000. Not just in absolute dollars, in trajectory toward your goals, in psychological impact, in time required to recover. This means your risk management must evolve as wealth grows. The aggressive allocation appropriate at 30 becomes increasingly inappropriate at 50. Not because your goals changed, because your exposure changed. Most people fail to adjust. They maintain the same aggressive positioning that served them early, not recognizing that the risk-reward calculation has fundamentally shifted. They're optimizing for accumulation when they should be transitioning toward preservation with growth. Second, tax efficiency becomes increasingly important as wealth grows. Early in wealth building, tax optimization is nice but not critical. The amounts involved don't justify complex strategies. But as you move toward these upper wealth tiers, tax drag becomes one of your largest expenses. The difference between tax-efficient and tax-inefficient portfolio management can easily exceed 1 percentage point annually. Compounded over the final decades of wealth accumulation, this represents hundreds of thousands in retained wealth. Asset location: holding tax-inefficient investments in tax-advantaged accounts, tax-efficient investments in taxable accounts, harvesting losses strategically, managing capital gains recognition, utilizing Roth conversions during lower income years. These strategies become increasingly valuable as wealth grows. Third, protect against lifestyle inflation. This is the silent killer of wealth accumulation. As income increases, spending increases proportionally or faster. The psychological rationalization is powerful. You've earned it. You deserve it. Life is short. All true. And also financially destructive if it prevents reaching your wealth goals. The successful pattern is this. As income increases, allow lifestyle inflation in certain chosen categories that genuinely enhance life quality, but maintain or even decrease spending in other categories. Let income growth translate primarily to increased savings and investment. This requires conscious choice and active resistance to social pressure. It requires defining your own spending priorities rather than defaulting to peer consumption patterns. It's psychologically demanding. And it's also the difference between reaching upper wealth tiers or plateauing at comfortable but not financially independent levels. Fourth, diversify beyond traditional portfolios as wealth grows. At lower wealth levels, simple diversified index portfolios are optimal. But as you approach these upper tiers, portfolio options expand. Private investment opportunities, alternative assets, business ownership, real estate beyond primary residences. These aren't necessary, but they offer opportunities for enhanced returns and additional diversification. The key is approaching them with the same discipline and analytical rigor you've applied to traditional investments, not as get-rich-quick schemes, as thoughtful allocations based on actual risk-return assessment. Finally, and this is critical, maintain your system. The behaviors and strategies that got you to your current position are the same behaviors and strategies that will take you to the next level. Resist the temptation to abandon proven approaches in favor of more exciting or aggressive strategies. The plateau that many people hit isn't because their strategy stopped working. It's because they abandoned the strategy that was working. They get bored. They get impatient. They convince themselves they need something more sophisticated, more aggressive, more exciting. What they actually need is more of the same, executed with continued discipline over a longer time horizon. The strategy that takes you from 0 to 300,000 is the same strategy that takes you from 300,000 to 600,000. It just requires more time and continued discipline. Consistency beats optimization. Discipline beats cleverness. Time beats timing. These principles don't change just because your account balance grew. If you're earlier in your wealth building journey, looking at these thresholds and wondering how to bridge the gap, here's what you need to hear. First, be brutally honest about your actual financial situation. Not what you hope it is, not what it could be if several things go right. What it actually is right now, your current income, your current expenses, your current savings rate, your current net worth. Most people operate with optimistic estimates that don't match reality. They underestimate spending, they overestimate savings, they assume future income increases that may or may not materialize. This optimistic bias leads to inadequate strategies and delayed action. Get the actual numbers. Track spending for 3 months. Calculate actual savings rate. Measure real net worth. This might be uncomfortable. Do it anyway. You cannot navigate effectively with an inaccurate map. Second, understand that reaching these upper wealth tiers requires sacrifice. Not suffering, not misery, but sacrifice. Consumption foregone, immediate pleasures delayed, comfortable defaults questioned and changed. The marketing message around wealth building is that you can have everything. Live your best life now while also building millions for later. This is mathematically incoherent for most income levels. The savings rates required to reach upper wealth tiers require genuine lifestyle trade-offs. This doesn't mean living miserably. It means choosing consciously. It means spending heavily on things that genuinely matter to you while spending little or nothing on things that don't. It means rejecting default consumption patterns in favor of intentional resource allocation. Most people aren't willing to make these trade-offs. They want the outcome without the process. They want the wealth without the sustained discipline. And so they don't reach these levels. Not because they couldn't, because they wouldn't. Third, focus intensely on income growth, especially early in your career. The difference between a $50,000 income and a $100,000 income matters far more than the difference between a 6% return and an 8% return when your portfolio is small. Invest in skills that have market value. Pursue roles with growth trajectory. Be willing to change employers to capture market rate compensation. Negotiate aggressively on salary and benefits. Treat career development as seriously as portfolio management. This isn't just about money. It's about accelerating your wealth building timeline. An extra $50,000 in annual income, saved and invested, can compress your timeline by years or decades. Fourth, avoid debt except for productive assets. Mortgage debt on a reasonably priced primary residence? Acceptable. The home provides value, likely appreciates, and the mortgage interest may be tax advantaged. Student loan debt for a degree with clear career return? Often justifiable, though minimize the amount. Credit card debt? Car loans beyond what you can easily afford to pay cash? Any form of consumer debt used to finance lifestyle? These are wealth destroyers, not just because of interest costs, because they create cash flow obligations that prevent savings, reverse compound growth, and create psychological stress that leads to poor financial decisions. If you currently carry consumer debt, clearing it becomes your first financial priority, before aggressive investing, before building emergency funds beyond a minimal level, before almost anything else. The return on paying down high-interest debt exceeds any investment return you're likely to achieve. Fifth, build your investment strategy around your actual behavior, not theoretical optimal behavior. The theoretically optimal investment allocation means nothing if you can't maintain it through market volatility. The theoretically optimal savings rate means nothing if it requires willpower you don't possess. Start with a strategy you can actually execute. Then optimize gradually as discipline strengthens. An 80% optimal strategy that you maintain consistently will dramatically outperform a 100% optimal strategy that you abandon during the first market decline. Finally, prepare for this to take longer than you want, much longer. The timelines we discussed earlier aren't pessimistic, they're realistic, and they assume consistent execution, favorable market conditions, and no major setbacks. Real life involves job losses, market crashes, health issues, family emergencies, behavioral lapses. These things will happen. Your timeline should account for them, not assume their absence. The people who successfully build significant wealth share a common trait. They started earlier than they felt ready. They maintained strategy longer than felt comfortable. They resisted social pressure that pushed toward consumption, and they measured success in decades, not quarters. This path is available to you. It's not easy, it's not quick, it's not comfortable, but it's proven, it's achievable, and it's worth it. Before we conclude, let's address the behavioral mistakes that derail wealth building more reliably than any market condition. Mistake 1, trying to time the market, waiting for the perfect entry point, pulling money out during volatility planning to buy back cheaper. This feels strategic. It's actually one of the most reliable ways to destroy long-term returns. Study after study shows that market timing reduces returns for the vast majority of investors. The few who time successfully once rarely repeat it consistently. The cost of being out of the market during recovery periods exceeds any benefit from avoiding declines. Mistake 2, over-concentrating in individual investments, putting a large percentage of your wealth into single stocks, single properties, or single asset classes because you're convinced they'll outperform. Sometimes they will, more often they won't. And when they don't, the impact on your timeline toward these wealth thresholds can be devastating. Diversification isn't exciting. It's insurance. And insurance is valuable precisely because you don't know when you'll need it. Mistake 3, chasing performance. Investing in whatever asset class or strategy performed best recently, this guarantees buying high. It ensures you enter positions after most gains have occurred, and it leads to constant portfolio turnover that generates costs and destroys returns. Mistake 4, letting perfect be the enemy of good. Waiting for perfect knowledge before taking action, endless research, constant strategy refinement, planning to start once everything is optimized. Meanwhile, time passes. Compound growth that could have been working isn't. Start with good enough. Optimize as you go. done imperfectly beats perfect never started. Mistake 5. Emotional decision-making during volatility, panic, selling during market declines, euphoric buying during peaks, letting fear or greed override strategy. This is how decades of disciplined wealth building can evaporate in months. Write down your investment policy during calm periods. Follow it during volatile periods. Remove emotion from the decision chain through predetermined rules. Your emotional state should never determine your financial strategy. Mistake 6. Failing to automate, relying on willpower and manual execution. Every decision point is an opportunity for behavioral failure. Every manual step is a point where discipline can fail. Automate contributions, automate rebalancing, automate bill payment. Remove the requirement for repeated good decisions. Make the default path the wealth building path. Mistake 7. Lifestyle inflation matching or exceeding income growth. This is perhaps the most common reason people with high incomes fail to build substantial wealth. They earn more, they spend more. Net savings remain flat. Decades pass. Wealth accumulation barely progresses. Avoid this pattern at all costs. It's subtle, it's socially reinforced, and it's financially fatal to reaching upper wealth tiers. These mistakes aren't theoretical. They're patterns observed repeatedly in longitudinal studies of household wealth accumulation. Avoiding them doesn't guarantee success, but failing to avoid them virtually guarantees you won't reach these upper wealth thresholds. We've covered substantial ground today. The actual wealth thresholds for the top 20, 5, and 1%. How wealth composition differs at these levels, the time horizons involved, the psychological challenges, the strategies for existing asset holders and aspiring wealth builders, the critical mistakes that derail progress. If you take away only one thing from this discussion, let it be this. These wealth thresholds are achievable for a significant portion of working professionals, not through luck, not through inheritance, through sustained discipline, strategic behavior, and sufficient time. But they're achievable only if you're honest about what they require. They require sacrifice. They require decades of consistent execution. They require resisting powerful social and psychological pressures. They require maintaining strategy through periods where it feels like it's not working. Most people won't do this, not because they can't, because it's uncomfortable, because it requires trade-offs they're not willing to make, because it demands time horizons that feel impossibly long. This is actually good news for you. It means the path is less crowded than it appears. It means sustained discipline has disproportionate value, precisely because so few maintain it. The wealth building journey isn't about being smarter than everyone else. It's not about finding secret strategies. It's not about perfect market timing or exceptional investment returns. It's about doing boring things consistently over very long periods. It's about resisting temptation when everyone around you is indulging. It's about maintaining course when every instinct says to abandon ship. This is hard, but hard doesn't mean impossible. And the rewards, measured not just in dollars, but in freedom, security, and options, are substantial. You now have clarity about the terrain. You understand the targets, you know the timelines, you recognize the psychological challenges. You have frameworks for strategy. What happens next is entirely within your control. The brutal truth isn't that these thresholds are unreachable. The brutal truth is that most people won't do what's required to reach them, even though they easily could. Don't be most people. Start today. Stay consistent. Trust the process. Ignore the noise. Maintain discipline. Give it time. The mathematics work. The strategies work. The question is whether you'll work the strategies long enough for the mathematics to deliver. Your wealth building journey doesn't begin with perfect knowledge or perfect conditions. It begins with a decision to start and the commitment to continue. Make that decision. Make that commitment. Your future self will thank you. Thank you for your time and attention today.